The housing market in the United States is currently facing a multitude of challenges that collectively indicate an impending seismic shift. It's not merely a matter of fluctuating property values, but rather a complex interplay of various economic indicators, homeowners' financial struggles, and evolving dynamics in the real estate sector. This article seeks to dissect the key factors contributing to this unsettling state of the US housing market and shed light on the implications for prospective buyers, sellers, and homeowners nationwide. One of the most prominent concerns in the US housing market is affordability. As property prices continue to surge in many parts of the country, home ownership is becoming an increasingly distant dream for many Americans. The housing shortage, driven by a lack of new construction and increasing demand, has led to fierce competition among buyers and driven up prices to levels that are often unsustainable for average households. This situation has left many prospective buyers locked out of the market or heavily burdened by the financial commitments associated with home ownership. Additionally, the COVID-19 pandemic has played a significant role in reshaping the housing landscape. Remote work trends have made location less of a limiting factor for buyers, causing migration patterns to shift, with suburban and rural areas seeing increased demand. This has put pressure on housing inventory in these regions, further exacerbating the housing shortage. Combined with historically low interest rates and a surge in real estate investment, the US housing market is in a state of flux, with implications that reach far beyond property values. This article will explore the intricate web of factors contributing to this situation and its potential ramifications for all stakeholders in the housing market. Section 2. Household financial struggles. Many people in the United States are facing tough times, and it might lead to a lot of homes being put up for sale. Why? Well, new information from the US Census Bureau gives us a gloomy view. For 3 years in a row, the money that the average household makes has gone down. It's a big problem. After paying taxes, the money left over has dropped by a whopping 8%, which is the biggest drop ever in the US. Because the cost of living is still high, some homeowners are using the money they've invested in their homes to pay their bills. This is a warning sign that suggests we might see lots of houses for sale soon. To put it simply, people are making less money, and the money they have left after taxes is even less. So they're using the value of their homes to pay their bills. Imagine you have a piggy bank, and you keep taking money out of it to pay for your everyday things. Soon you might run out of money in your piggy bank, and that's what's happening to some homeowners. When they need money, they sell their homes to get it. If many people do this at the same time, it could mean a lot of houses on the market, which might affect the prices of homes and what it's like to buy or sell a house. Section 3. Uninsured homes and low savings rates. A staggering 12% of homes in the United States, roughly over 10 million houses, are uninsured. This alarming statistic can be attributed to the shockingly low personal savings rate in the US, which currently stands at a mere 3.5%. These numbers are reminiscent of the period just before the 2008 housing crash, a dangerous precipice made even riskier by the fact that interest rates have reached a 20-year high, hovering around 5.5%. Mortgage rates are inching perilously close to 7.5%, pushing the average monthly housing payments to an eye-popping $2,900, nearly $1,000 more than the average rent for an apartment in the country. Section 4. Housing Affordability Crisis. The CEO of ready, Glenn Kelman, offers an opinion on the housing market's one positive aspect. The situation doesn't seem to be worsening, but that's hardly reassuring. Goldman Sachs' Housing Affordability Index has reached a historic low, illustrating the challenging market conditions. In August, the average sales price of a single-family home touched $42,282, a near match to the previous month's record high of $42,227. The interest rates on 30-year mortgages have remained above 7%, a considerable departure from the 3% rate in earlier times. Section 5. Housing inventory and regional disparities. A look at the housing inventory across different regions of the United States reveals notable disparities. The Northeast and Midwest, often referred to as the Rust Belt, have the lowest inventory percentages, with only about 0.5% of homes on the market. In contrast, states like California boast higher inventory numbers. In southern states like Tennessee, Texas, Georgia, and Florida, inventory levels can exceed 1%, with some markets reaching 1.5% or higher. Section 6. Lock-in effect and its consequences. The lock-in effect in the housing market is kind of like when you have a fantastic deal that you don't want to give up. Many homeowners across the United States have these great deals in the form of super low interest rates on their mortgages. These rates are incredibly low, ranging from 2% to 3%. It's like buying your favorite toy on sale, and you're paying very little for it. However, if they decide to sell their current homes and buy new ones, they would have to give up these super low interest rates and start paying the higher rates that are currently around 6% to 7%. It's like trading in your favorite toy for a newer one, but you have to pay more for it. Because of this, many people are holding on to their current homes and not buying new ones. This is causing a significant issue because there aren't enough new homes available for sale. In July 2023, there were only 374,000 new homes for sale, which is a lot less than the more than 1 million homes available just 2 years ago. So this lock-in effect is causing a shortage of homes for sale. Moreover, the lock-in effect doesn't only affect individual homeowners, but has wider implications. When people aren't selling their homes, it slows down the whole housing market. You can think of it like a traffic jam on a busy road. The more cars or houses stay in one place, the harder it is for others to move or buy new homes. This can lead to a situation where some people who want to buy their first home or upgrade to a bigger one might find it really tough because there aren't enough homes to choose from. It's a bit like when you want a particular toy, but everyone else wants it too, and there aren't enough toys for everyone. This can make the price of homes go up because there's so much demand and not enough supply. So the lock-in effect is like a puzzle piece in the bigger picture of the housing market, affecting not only individual homeowners, but also the overall availability and pricing of homes. Section 7. Impact of rising mortgage rates. The past year and a half have seen some important changes in the world of money. The folks at the Federal Reserve, who are like the money managers of the country, have been raising interest rates. Why? Well, they wanted to make sure things we buy, like toys or ice cream, don't cost too much too quickly. That's called inflation. But here's the thing. When they make interest rates go up, it also affects the interest rates on the money you need to borrow to buy a home. And now these interest rates for home loans are higher than they've been in 20 whole years. Some people hope they'll come back down, but the way things are going in the economy makes it seem not very likely. So, what does this mean for people who want to buy a house? Well, it's like when you want to buy a new video game, but it suddenly costs more than it used to. It can be tough to save up enough money to get it. In the same way, higher interest rates make the monthly payments on a home loan more expensive. This can be a problem, especially for folks who are buying a home for the first time or don't have a lot of money to spare. They might have to settle for a smaller or less expensive house, or they might have to wait until the rates go down, which might take some time. So, these rising mortgage rates are like a puzzle piece in the housing market's big picture, affecting how much people pay for their homes and how they decide which homes to buy. Section 8. The ongoing slowdown. The slowdown in the housing market isn't just a problem in one place or for one group of people. It's happening all over the country. It's like when you're playing a game and you and your friends are all stuck on the same level. It's tough for everyone. One of the main issues causing this slowdown is that homes are getting more and more expensive. It's a bit like when the price of your favorite toy goes up and you can't afford it with your allowance. Many people find it hard to afford these higher-priced homes. It's a bit like when you want to buy a new video game, but it costs a lot and you don't have enough money to buy it. The same goes for houses. They're getting so pricey that people, especially those who are trying to buy their first home, find it really hard to get into the market. Moreover, this slowdown doesn't just affect people looking to buy a house. It also has an impact on the whole neighborhood and the local businesses. It's like when a lot of people in your community stop playing the same game and it's not as fun anymore. When people buy homes, they often need to do things like buy furniture, hire painters, or get movers, and this creates jobs and helps local businesses grow. So, when the housing market slows down, it can affect employment and the economy in your community. This is why it's not only a concern for people looking to buy or sell homes, but also for the well-being of the whole neighborhood and even the entire country. Section 9. Helping struggling homeowners. Now, let's talk about how we can help people who might be facing tough times with their homes. Nearly 300,000 people who bought homes in the last 2 years might be in a tricky situation. It's like when you're playing a game and you can't seem to get past a really challenging level. These folks might find it hard to pay for their homes or might be told to sell them. Many of them are new to home ownership. It's their first time playing this game and they might not know all the rules and strategies to win. Helping these homeowners is really important because we want them to succeed. We can do this in a few ways. First, we can give them tips and tricks for the game, which is like offering them financial education. The US housing market stands at a critical juncture with numerous economic indicators and homeowner struggles converging to create uncertainty. The ongoing shift in dynamics between buyers and sellers is poised to influence the market significantly. As the situation unfolds, it's crucial to keep a close eye on the bigger picture and how it impacts the real estate landscape. If you have any insights or observations on housing trends in your local market, we'd love to hear from you. Subscribe and share your thoughts in the comments section below.